So joining us now is Raoul Paul, founder of the Global Macro Investor and of Real Vision. Now, Raoul, you do such a great job of articulating your views on Real Vision. So any of our listeners that want to know what you're predicting, we suggest you head over there. Now, we'd like to spend the time with you to pick your brain a little bit about your process and try to understand it better. Now, I know from you, you don't shy away from making some pretty bold calls, but at the same time, you have a great track record on those calls. Now, how did this outside the box thinking come? Was it natural that you were always had it, or is it something that you had to develop?
Interesting. I kind of stumbled into it, and it's the fact that I didn't realize, but I was ideally suited to global macro in the way that it works because different people have different skill sets. And what I found out is I learned technical analysis very early on, just because that was the first job that I had was teaching people, was supporting a product called Teletrack in the early '90s, which was a technical analysis product. And I realized that I was a visual person. I saw the world in pictures. And so for me, global macro and that investment framework became much easier because it was about seeing the big picture. So when you see the big pictures, I kind of started to understand. I think it was probably originally whether it was Soros on Soros or one of the early Soros books was about how he would assess the probabilities to various outcomes and reassess the probabilities. And I realized that I could apply that because the charts were giving me something which was a probabilistic outcome of something that I could see in the future. And so it was starting to give me that roadmap of, okay, I understand that there are no certainties. I look out into the future and there's certain probabilities. And if I see that picture that is consistent across a number of different things, then it becomes the ability to make bigger calls. So I kind of stumbled into it. And I started speaking early on in my career in the mid '90s to some of the big hedge fund guys, people like Paul Tudor Jones, stuff like that, Lewis Bacon at More Capital. And I started realizing that how they were thinking was in a similar way. And I stumbled into it and realized, okay, I can do this. Well, at least I think I can. They were obviously better than me, but there we go.
I love the fact that you actually said that because my follow up question was actually going to be about technical analysis because Kevin always calls it the dark arts. See, I love using technical analysis, and he's a little more suspect of it. And listen, and when we talk about macro, there's obviously a lot of macro data that comes out there, but clearly your top down process then evolves from first seeing the bigger macro and then looking for when is the trend emergent. Is that a good way of describing it?
Yeah, I mean, look, there are different people in macro, and the people who are skeptical of charts tend to be the more bottoms-up macro kind of model-driven in their approach, and it's just a different way of approaching stuff. So they're both equally good, just different ways of doing it, just because different people have different skill sets. And so yes, I get the big picture from that whole thing, and I found that has been the better thing for me in the way that it works. And I found that charts are the single most useful way of understanding market psychology and what's going on. So you don't need to believe in charts, you don't need to believe in chart patterns, but you have to understand that market psychology is written in that chart. You kind of know
Right.
what the market has been doing, what people have been doing.
Um, it's Kevin here, Raoul. I think it's Peter Brandt that has a great line. He says something like, "The bottom of the ocean is filled with all sorts of captains who also didn't believe in charts."
That's dead right. And I learned this from it was bizarre because early in my career, I was a chart guy because I realized that helped me visualize everything. And I never forget when I first got introduced to Paul Tudor Jones, I was like, well, how do you look at this stuff? He goes, well, I couldn't live without a chart. Basically,
Right.
80% of his process was the chart. And then once you saw the chart, he would then dig in and do the work. And I found the same was true of Stan Druckenmiller. The same was true of Lewis Bacon. The same was true of George Soros. The same was true of most of them. There were some that didn't use them at all, but really a lot of them did, and they all started with it. I asked Mike Novogratz recently in an interview. I said, what happens if you couldn't look at a chart? He goes, well, I can't trade. Just give up.
Ah. Now, what do you think about, you mentioned Stanley Druckenmiller, and he's often kind of used the internals of the stock market to give him signals about the economy. Do you worry that with the changing nature of more and more algorithmic trading and more quants, that some of those what had typically been very reliable indicators are no longer working?
I think about this a lot, as we all do. I'm not as convinced as others are that the market is so screwed up. If I look at the year-on-year rate of change of the S&P 500 and look at it against the ISM, it's still consistent. So nothing's the correlation between asset prices and the business cycle seems consistent. Is the business cycle a bit screwy? Well, this is the longest one ever. Are we going to go into recession, or are we going to bounce yet again from this kind of 1% to 0% GDP level? We'll have to wait and see. Is the economy being manipulated? Probably. I don't see the markets as much. However, at a top-down level, you really do see the impact of passive. So the passive fund flows are really what's driving that, value growth divergence, and some of the other things that Stan will pick up in some of the other things. It's, the indicators are less good because of, I think the passive flows are a big problem. You need to strip some of that out somehow.
Right. And so in terms of the passive, I always kind of say to people, those who complain about all the passive should realize if you are an active investor, this just gives you more opportunity because the stocks that aren't in the index are just cheaper.
Yes. But the question is Mike Green's done a whole lot of work. I mean, an extraordinary amount of work on this. And basically, passive is eating the world. So unless something significantly changes, there is no reason to see a reversal in the, let's say, active versus value. I mean, momentum versus value, because there is nobody there to buy enough value to make a difference. So passive is over 52% of the market now, and it's increasing almost on a quarter by quarter basis. Passive is basically eating the rest of the world, and that's troubling.
But don't you think, though, as the value gets cheaper and cheaper, eventually it's kind of like the best cure for high prices is high prices, and the best cure for low prices is low prices?
I do, but the structural flows of capital from the baby boomers exiting means that there's so much active that's being just squeezed out of the market. There's just not enough active people. So can stocks remain cheap for a long time? Yes. So, does value still work? Yes, it probably does. But you're really, really fighting a headwind of every single baby boomer having to sell the stock market. And what they're selling most of the time at first is all active and switching to passive. All the millennial cash flow is all going into passive. So it is a structural shift that I'm not sure how you take advantage of it, because there's no kind of price discovery if there's not enough capital to move the price.
Right, and I guess eventually it solves itself, but the question is, can you take the pain in the meantime? Now,
how long is that? I mean, could it be decades? I mean, look how long Europe's been cheap for.
Yeah,
it's the same argument. Europe and Japan have been the same argument for decades now.
Right. So now you mentioned some different hedge fund managers, some very famous names there. What do you feel like back when you were covering them as a sales trader? They were probably swinging it around pretty good, and it was the days of the swashbuckling hedge funds, and now they feel just more like kind of boring asset collectors as opposed to the good old days when Soros broke the Bank of England. What can you kind of comment about what you see in the hedge fund industry over the last couple of decades?
I mean, I've seen this whole thing from start to finish, and I've written about it a lot, about the death of the hedge fund industry and macro, the industry that I love, and how that is changing. And essentially, to talk you through the history of it, is by the mid 90s, Tiger and Soros and Tudor, Tiger at that point was $20 billion, which was absolutely enormous for a hedge fund then, back in those days. And these were macro, high volatility, high return strategies. And these guys were the gods of the industry, and they'd made more returns than anybody had ever made in history before. So that was the famous days of it all. Then what happened is, I joined the industry. I started working for a hedge fund and running a global macro hedge fund in 2001, or 2000 actually. And over that period, while I was running a hedge fund, we started to see changes that the pension funds had already have gaps in their funding. So they were going out the risk curve and buying alternative assets. So that was the rise of the hedge fund bubble. And what happened is the pension funds drove it. The problem is the pension funds said, well, you can have my $250 million, but in exchange, I don't want your 15% volatility because I've got to model this within my actuarial tables and put this into my outcomes for these pensioners. So I need it to look more like a bond. So can you give me 12% vol? And so we were all like, sure, we'll try and do that. So everyone's risk went down. Then they said, actually, what we want is 8% vol. And everybody's risk went down. At this point, I decided to leave because I saw where this is going. I said, look, everyone was going to monthly reporting of NAV, and they were then reducing volatility to 8%. And I'm like, well, this is not for me. So at that time, and I'd started, and again, not that I'm in the same league of him, but I'd started at the same time as Alan Howard had started his fund. And so Alan took a different approach. So Alan had more capital than us. So he basically said, fine, I'm just going to hire tons of traders, have a diversified portfolio, and I'm going to lower volatility to 6%. And
Right.
if I lower volatility to 6% and I can generate 10% returns, because Alan happens to be one of the best traders in the world, and interest rates were the great trade, and he's the best interest rate trader probably there ever is. And what happens is Alan gets all the assets in the world. So suddenly $80 billion flow to Alan Howard, and everybody else is out of business who has a higher volatility approach. So that's killed the big swinging, dick hedge fund approach. That's now gone unless you've got a large private pool of capital. At the same time, you've got Paul, Lewis, George, and a whole bunch of these guys who have all basically hit their 50s and 60s in age, and they are now billionaires, the whole lot of them. So their motivation goes from, actually, if I can turn my entire net worth into a bond, I don't need to take the risks because now I'm a billionaire, I just want to keep it. So their motivation changes. So all of them did the same thing, which was hire a bunch of traders, have the diversified Alan Howard approach, and lower their returns to 6% volatility, and if I can make 8%, 10% returns, I'm great. So the industry then went to asset gathering, and then the rise of the asset gatherers happened over that period of time. But what the dirty truth is returns sucked. So nobody made any
Right.
money any longer. And then what happened is the moment you have an industry like that, and it happened to Alan in London, is the moment something goes wrong in your performance, you're under such extreme pressure by the investors who are the fund of funds and pension plans now, not the family offices who didn't mind the 15, 20% volatility. Anything goes wrong and they bail. And Alan Howard went
Right.
from 80 billion to 3 billion in a year and a half. It's
Holy.
extraordinary.
Wow, I had no idea. Now you mentioned the kind of cut your losses quickly to keep your volatility down. I kind of think that that's changed the nature of trading in global macro, and that you do get this kind of mini herd, these little bubbles where everyone hops on something, and then the moment it starts to go against them, they can't take the pain. Do you think that that opens opportunities for non-institutional money, those who are willing to take a little more volatility and sit through it? And like I'm thinking about your own personal trading, do you say, I know that these guys can't take a drawdown, but I can sit through this, and therefore I'm going to take my kind of time horizon and lengthen it, and that is my edge?
Yes. So I looked at this, and when I was doing the hedge fund, I realized we were all doing 2-week trades.
Right.
Because 2-week trades, you try and make a bit of money, then you protect your P&L because you have to report monthly. If not, the pension plan will be on the phone saying, why did you screw up this month? So
Right.
you became motivated to only show positive returns each month if you could. So it made everything ridiculous. So it didn't matter where you bought a security or sold a security. It only mattered, and how much money you'd made in it. It only mattered what your mark was that month.
Right.
So it's ridiculous. So as opposed to an annual P&L, you were going down to monthly. So I realized at that point that the actual arbitrage was time horizon because nobody could have a long time horizon. So family offices were doing much better returns because they just didn't have the same restrictions. People who were managing their own money were generally doing better. Anybody who had to manage um, based on the volatility structure was not doing as well. And I'd seen it because I thought the best investor I'd ever seen was Nick Roditi, who was the other guy at Soros that nobody knew. And he was astonishingly volatile. He was probably 20 something vol. But oh my God, his returns were huge. And he had some big losses in that too. But an amazing, amazing, amazing investor. And I realized that his edge in the whole thing was that time horizon. And I realized it for myself. So that's why I actually started the Global Macro Investor. Because I said, listen, I think the industry's wrong. I'm stupidly, I mean, who am I to say this? But I said, look, the industry's wrong. I think the industry needs to go to longer term time horizons, and I'm going to prove it. And that's why I started the Global Macro Investor. It was exactly that argument. Is I said, look, you need to, all you have to do is lower the size of your trades and stick with the long term view. Because as Paul Tudor Jones had told me, he said, look, what makes the best investor or the best trader is somebody whose idea horizon matches with their time horizon. But most people don't. Most people trade 2 or 3 week views and base it around their long term macro view. I mean, that's nonsense.
Oh, you're
Um,
right. Yeah,
but
you're
everybody
absolutely
does it.
correct. Yeah,
Everyone says
yeah,
we're going into recession, blah blah blah, and I'm then going to trade a 2 week view. Well, a piece of economic data in macro world is economic data. It only comes out monthly. You get one data
right.
point in a month, so
That's
it's nonsense. And this is what people misunderstand about so much is most people have a much shorter time horizon. And that's why I find it much easier to operate in the longer term time horizon because I think over time you have an edge over the machines because for a machine to try and understand the probabilistic outcomes of something in the future, let's say of the euro falling or whatever it may be, or treasury yields falling, it's impossible for them to process the kind of information, the textual information that humans do still. But for it to understand the flows and how to affect something in the next 3 minutes, they have a bigger advantage over humans. The longer out you go, the more advantage humans have.
right. So, what is your like? Can I ask like a typical trade for you? Like, how long are you thinking? Is it like that year long process? Like, is it that long?
Yeah. So generally between a year, I'm sorry, 3 months and 2 years.
Right. So
So
you're
if
not
like
like
treasuries, trades like that, I'll be in for a year, 2 years, and not and sometimes not even trade around them.
right.
And other times I will. It depends. Currencies I've traded around a bit more, but really currency. I mean, here's a great example of my view and how I think about things is, and again, I sound a little bit arrogant doing this, but back in whatever it was, 2013, the euro was 148 and a half. It had topped out, and I was living in Spain, and I'd seen the mess of what was going on in Europe. We almost lost our banking system in Spain at the time, and all the other mess. And I just thought the euro is way, way, way too high versus what it should be. And using the charts and using all the analysis that I do, I'd made the decision myself personally that listen, I need to change everything that I do to dollars now. And so I changed the billing of Global Macro Investor and told all my clients I don't want euros, I want dollars. I then took all my life savings
Were you
and
one second?
I
Were you doing
bought.
the opposite? Were you doing the opposite of Giselle? I
Yes,
think Giselle
exactly the
was
opposite.
asking. That's right.
That's
She was
exactly.
asking for euros, and you were asking for you saying no more
It
euros.
was
I want
exactly that.
dollars.
It was exactly that time, between that euro at 160, euro at 148 and a half when I did it, and I switched all my life savings into dollars. I then forced myself to buy property, so I bought a house where I'm talking to you from today in Little Cayman, where I ended up building a house, and also I bought a small place in Miami. The point being is I then couldn't trade it. So I
Ah,
couldn't get in my own way because I thought there was a very high chance that the euro goes to sub parity against the dollar, probably goes to 80 cents. So I'm like, well, I'll do that trade all day then.
right.
Um, and that was
So
the way
you
of
made
doing it.
yourself illiquid so you couldn't trade out of it, and I know that feeling all too well because you are, as a trader, tempted to do it. Now you've mentioned, I saw you nail the bond trade this summer, and I've seen a couple of things that you've said, and you've definitely lightened up on a trade. I know a lot of people talk about putting trades on, and less talk about when they take things off. And obviously, each and every investor is different. But could you walk me through a little bit of your process of how you decided, like, to take some profits and
It's
how
hard.
you basically?
That's harder.
Yeah,
That's much harder than putting a trade on. In fact,
for
it's
sure it is.
extremely
Yeah.
hard. It's extremely hard. The only reason I've had the levels of conviction in the fixed income trade is I've done it before, and I've seen it, and I know a business cycle. When you've got something anchored like a business cycle, you have a much higher probabilistic outcome. Now, maybe I'm wrong with the business cycle. Maybe, we flatten out here. Well, I'll have made a ton of money in the trade, and I'll come on to what would make you take it off in a sec. So when you're anchored to the business cycle, that does help significantly. But otherwise, it's very difficult to know. Like with Bitcoin, where the hell did I take it off? I put it on at 200. I took it off at 2,000. I thought I was a hero. It went to 20,000. And I looked like an idiot. So it is very difficult to know. And particularly, I find it very hard in the ones that, particularly with the single stocks and stuff like that, or even with options where you start to make multiple returns, 3, 4, 5, 6, 7, 8, 10x, because it completely consumes your mind in the end. It's difficult to see what it is. It was only the Eurodollar trade and the bond trade that I've kind of lived through a lot in the past that I knew better how to do it. But generally, as a rule of thumb, I use a whole load of technical analysis, trying to use the longer term stuff. So monthly DMARC, kind of monthly RSI divergence. If I'm in a big trend, I'll then look at how big the positioning is as a percentage of how big it's ever been in the past, versus open interest to get some textualization. I kind of think through, obviously, what is anything changing. So there's a difference between taking profits or closing out a trade. Taking profits is a personal thing, and sometimes I just think, you know what, money in the bank's worth more than not having it at all, than the ability to give it back. So sometimes you just take profits because you want to. Other times it's because something has changed, and that also is very hard. The biggest screw up I've ever had is when I didn't listen to my kind of framework that had changed. But when things change in your framework, you need to be honest with yourself. It is difficult. Putting a trade on is easy. Taking it off is really
Right.
bloody difficult.
No, you're for sure right. So a question for you: what do you think distinguishes a good trader from a great trader?
It depends what style you have. I think there are some people who have left and right brain abilities, and that's a person to have the creative big picture thought, but with the attention to detail. And there's very few of those people around, and I'm certainly not one of them. There are some people who understand deep in the weeds and then the really big picture, and those guys can be very good. I find the actual answer to most what makes a great investor, I won't use trader because it's a slightly different skill set, I think, is people who understand the knock-on effect. And that's so you don't look at what's happening today in the news. It's what does it mean for that, and what does it mean for that, and what could it mean for that? And that's where the money lies.
For sure, I completely agree. I have this great story that I tell about Norway when they found oil off the coast, and everyone was busy, trying to find all sorts of ocean rights and investing in the in all the kind of Norwegian stocks that were basically going to benefit from this huge bull market. And there was a fellow that decided to come up and buy all the Norwegian artwork. And he realized that once all this money got turned into wealth, that the Norwegians would buy their own local artwork. So he was already kind of one step ahead of them in buying what was cheap and realizing what was going to go from cheap to expensive.
Yeah, I mean, that's genius. I love stuff like that.
Yeah, for sure.
And some of the greatest trades, which we'll probably talk about later, have been about seeing the knock-on effect faster and more purely than anybody else. And that, to me, is when I see somebody do that, I'm like, okay, you are amazing. And there's some people who can do that very, very well.
Well, Raoul, you're selling yourself short because you do it all too often. For those who want to learn more and find out kind of your calls, where can they find you? Why don't you tell us a little bit about what you do at Real Vision and what you guys offer?
Yeah, great. I mean, the easiest place to find me is on Twitter. Like you, Kevin, I'm very active. I share a lot of stuff. I think out loud on Twitter. So at Raoul, RAOULGMI. So you can find me on Twitter to start engaging. Also, if you are interested in the world of finance and learning from the greats or learning from others, then, I built a business along with a few other co-founders called Real Vision. I think most people have probably heard of it by now, which is essentially the Netflix of finance. And there we have the world's most famous investors, greatest analysts, and Kevin Muir on it, who are there to guide us all. And it's an open platform in terms of we don't have an editorial bias. We just want the highest quality people. We just curate them by their intelligence and their kind of value add to the community. So if people want to take a look at that, just go to realvision.com. There's a whole free version as well, so you don't even need to pay. But if you do, it's only $180 a year. So it basically costs nothing to get trained how to become a great investor by Stan Druckenmiller and everybody else you care to name.
For sure. And for those who haven't tried it out, make sure you go, because you'll just be amazed at Raoul mentioned a lot of different names here in terms of famous people, and you'll find a lot of those people on Real Vision. There's a Stanley Druckenmiller interview that's one of the best that I've ever seen, and there's a whole bunch of things like people of that caliber, and I highly suggest that everyone go and have a look.